What's up, YouTube? Thank you guys so much for tuning in to another video. The stock market right now is crazy. Everyone wants to know the one magical question, and that is, are we in a bear market or are we in a bull market? And I'm going to touch on it today and give you guys some insight as to what I think. I'm going to be talking about a little technical analysis. This is going to be a high level. This is going to be a high level video. It's not going to be overly technical, or at least I'm going to try to not have it be that way. This is going to be more of a direction, and kind of like a sentiment type video to give you guys some ideas. That's exactly what I'm doing with my money and my investments. So taking a look right now, everybody's aware. We've had this Corona situation that's taken place over the past 4 months or so, and stuff has just been crazy, right? So, China's gotten hit, it's spread across the whole world, everybody's panicking. 401ks have just absolutely collapsed. Then they bounce back, and so people are wondering now, okay, so sounds like the collapse is over and all things are good, or maybe this was just like a little bounce and things are going to continue down. No one knows what to think. So there's a couple of things that I like to apply. Number one thing being common sense, okay? And then another thing is just kind of looking at some indicators to give me an idea of the direction of the market. So let me show you guys a few things. If we take a look back in 2008, which is the last time that we had a recession, right? So the stock market, actually, let's do that. So if we take a look here, the stock market, it hit a high, 1576.09. It dropped down for what was that? 5 months. Had a little decent bounce, and then it continued on. All right. If we go over here to 2020, stock market dropped 2 months, but it was a significant drop. All right, significant drop, and then it's basically popped back. And so, what I have found is usually when stocks do situations like this, it's indicative of a break of a trend. Okay, usually it's a break of a trend. And so I'm taking that analysis combined with the fact that we have a 12-year bull market. Well, yeah, 11 and a half years bull market, and just kind of applying some common sense and saying, okay, well, if you look at the international situation with the coronavirus, look at the unemployment numbers with, I think we're estimating right now, the New York Times says it's about 15%, which is a ridiculous amount. In 2008, the highest that the unemployment rate had hit was 10%, a little bit over 10% in October. We're now guesstimating that we're 15%, and literally we've only been quarantined for about a month now, right? 3 weeks or a month. So people don't really understand just how much unemployment really does affect the economy. Now, what I think is so confusing to a lot of people is that the stock market isn't exactly reacting the way that people think it should relative to the unemployment numbers and relative to how bad things are. So people are kind of confused. Well, things are really bad, but why isn't the stock market now continue to respond like that? And the reason that is because the federal government stepped in aggressively. They stepped in aggressively. The Federal Reserve, they stepped in and they just basically said, you get money, you get a check, you get a check. This is the week that I think a lot of people have gotten a stimulus check, right? So the government gave a lot of bailout to the airline industries, to a lot of the institutional firms. They pumped in tranquility, a lot of liquidity into the markets. And so what that does is that causes institutions to feel more safe because it's almost kind of like they can gamble and get a bailout if they go bankrupt. Right, so that's kind of basically what just happened here is that they're losing a lot of profits. There's a lot of uncertainty in the markets. There's a lot of lost wages. The government steps in and say, "Hey, listen, don't worry about it. If you're a small business, we're going to go ahead and give you a loan. We're going to give you money. If you're a large institution, we're going to give you uh, tens and not hundreds of billions of dollars so that you guys can continue to trade and invest and keep businesses going." And so the stock market has responded in a manner that kind of feels like, okay, well, great, well, Daddy's going to go ahead and bail us out. But what people don't understand is that Daddy bailing you out is only temporary, right? If you are, if you have poor money management skills, or if your situation is really a mess, um, you know, that's why they call it a stimulus, right? So you've been stimulated, you've gotten some funds, but overall, Once those funds run out, things are just going to kind of continue to go back down. All right, so stock market fell over 35%. It's bounced back over 20%. From a technical indication standpoint, for technical analysis traders, anything when the stock market or when a stock, I should say in general, falls and it gets over 50% of its value, then that's an indication of a bullish market, right? So right now, looking at this makes it look as though that the market it's dropped, it's bounced back, and then it's going to kind of continue to go this way. I don't think that's going to happen. Right now, our unemployment is at 15%. This huge pop here is because the federal government went in, aka the daddy coming in and investing, saying everybody gets the money, everybody gets the check, right? So what I think is going to happen is I think this is the last hurrah before the stock market begins to go down again. Now I think the next question is going to be, well, how low does the stock market go? I don't think anyone on this earth, in my opinion, can definitively tell you how low the stock market's going to go. Again, we can use the past as an indicator, right? So in 2008, the stock market fell over 50%, typically, right? So 33.93. We take a look at this here. That would be a little under 1,700. So the stock market would really have to fall down significantly somewhere over here, right? Before you can actually, I'd say even further than that, somewhere in this a little bit over 16 range, right? To be 50%. Is this possible? Absolutely, this is possible. But to see the thing is we don't understand really the absolute bottom for just so many reasons, right? So no one understands fully the full impact of being quarantined. No one understands full impact of earnings. No one understands the full impact of how long are people going to be unemployed? Or is the government going to continue to stimulate more money to the economy, right? How quickly can we rebound and get back to normalcy? This is just way too soon in the equation to understand that. But I can certainly tell you this. I can tell you that from looking at this, that right now the stock market is only like 10% off the highs, right over here. Like that's just there's absolutely no way that that should be the case, considering um, considering, well, actually, it's a little bit less, 15% ish. That just shouldn't be the case, considering how crazy and how severe the markets, I should say, our economy is. So again, this is the stimulus pump here. Then what I suspect is going to continue to happen is that as earnings begin to come out with Apple, Microsoft, and all the other big companies, right? The Johnson Johnsons, the Pfizer's, all the other big companies. I think overall we're going to continue to see the unemployment numbers continue to spike because there's going to be a lot more layoffs. Earnings are going to continue to surprise people because obviously everyone's at home, no one's spending money. Companies aren't spending money, layoffs are happening, budget cuts, furloughs, the whole nine. So, and then the stock market is going to continue to do this. Okay, you guys got to remember this was an international global virus that has literally quarantined countries. In 2008 we had the real estate concern, but really that was a liquidity thing. So everyone was investing in these credit default swaps and these CDOs. They were just basically leveraging bets and bets and bets and said that no one could possibly foreclose on their mortgage, and then basically everybody foreclosing their mortgage. And so that all the insurance premiums that companies had, that they were going to have to pay out, just basically everybody on the monopoly board just basically went bankrupt. And so looking at that, it fell over 50%. Looking at this now, I can't possibly see how, if you compare that to this, I don't think that that is quite as, I think it's just as severe. It might even be more severe because if you really take it to the extreme, we basically have a virus that is trying to take out the human population. Now, obviously, that's not going to happen, but if you think just from a pure virus standpoint, that's what it does. It spread extremely aggressively. It tries to take people out, and then there you go, right? We've just been fortunate enough that this hasn't that's not going to do that, but it can depending on your health and age and so forth. So again, economic numbers, unemployment, earnings, and so forth. I mean, there's no possible way, based on with the layoffs and furloughs, that the stock market's going to continue to go up on an 11-year bull market. It just isn't going to happen. There are some people who think that we're going to be in a V-shaped recovery, which means that we're going to drop down, and then the stock market just kind of goes here, then does that, and goes all the way up, and then the new highs. But we have to have a recession at some point, right? A typical recession, we typically have one in every about 8 to 9 years on average. right? The one before that was the 2000.com internet bubble burst, right? We had one 8 years later. Well, now we are in 2020, and that's 12 years, 11 and a half years, and here we are. And here we are with the stock market absolutely dropping. This, in my opinion, there's absolutely no way that this is the bottom. So, what do you do with your money? What's the thing that you do? Do you convert everything to bonds? Do you convert everything to stocks? Well, we have to more stocks. What do you do? Well, I think it all depends on your individual situation, right? So, if you are very close to retiring, right? Let's say you're going to retire in the next year or so. I think you have to sit down and ask yourself, well, uh, are you comfortable with where you are you comfortable with where you with excuse me with where you're at? If you aren't comfortable with it, I would probably look at just taking some loss and getting some bonds, or at least converting to some of it. If you're young right now and you're like, okay, well, I got some time to invest in the stock market, then I would just say play the course. Um, Me personally, I'm not a big fan if I think the stock if a stock is going to continue to go down of holding all the way down. I don't think that that's good solid advice. I know that that gets told to a lot of people, particularly regular citizens and individuals, that hey, if you just, they give all these things. If you just invested here, even at the top, and you held, I don't really care about all that. At the end of the day, if I think the stock market is going to fall another 25, 30%, I would rather just be in cash, right, or be in bonds, and then wait, and then start to see a recovery, start seeing better economic numbers, start seeing earnings start to come around, things like that, and then get a feel that the economy in the world is being stronger again, and that we're coming out of that, and then go back into the market. So me right now, I'm basically playing for bounces. So I think that at this point here, we've already gone over 50%. We're at a nice resistance level range, which is typically when the stock market would then begin to will fall off that and hit another support level and then continue down. So right now, I am literally just playing. When the stock hits a support level, these little bounces, and then sell out, get a nice little pop, and then get out of it. But in terms of the majority of my investments and my funds, I'm mostly in bonds right now, to be quite honest. I don't have a lot of stock. I do have some Apple, I do have some Tesla. Actually, no, take that back. I'm sorry, I don't have Tesla, but I do have some Apple, have some Microsoft, I have some Visa, things like that. Pretty much all tech stocks. But yeah, that's where I am with this. So again, you got to look at your overall total horizon. Look at where you are from your situation. If you are new to investing and you've never invested before, the contrarian statement that I'm going to give you guys is I would recommend that you just go ahead and just kind of start investing now. And the reason I say that is because it's important to get your feet wet. There's nothing like being able to have ownership of a stock and just say, hey, instead of buying on the new iPhone, why don't I go ahead and just actually buy the company that makes the iPhone, right? And so, is that a you know, is there ever really a bad time to buy stocks or investments? No, there's no ever really bad time, right? I mean, if you look at this here, the high of Apple is at 186. Right now, it's down to 116. As far as I'm concerned, that's a deal, right? You're getting it. Actually, no, no, wait a second. Sorry, guys. Apologies. Don't judge me on that one. I was like, wait, that doesn't look right. Something's way off on this. Don't judge me. That didn't happen. Okay, so the high was 327, 850. Right now it's 212, 253. It's still a deal, right? So what are you? You're a little bit over 15% or so discount. Now, if you got it down here, it would have been a hell of a lot less, a hell of a lot bigger discount. But I digress. All right, so I personally don't like to buy stocks when I see them bouncing hard like this. I like to wait for them to kind of go back to another support level, and then I'll start buying in a little bit more for a pop. I'll start kind of what I like to call staggering in. So I'll buy a couple thousand more, a couple thousand more, a couple thousand more all the way down, and then after I start to see the recovery, I'll start buying more. So, and I recommend you guys do the same thing, right? So if you're already in stocks and you can afford to do the horizon and you can afford to wait a long horizon, another 15, 20, 30 years, then maybe go half in bonds, right? Maybe keep some still in stock so that way you got a little bit of cash. So, if and when the stock market does begin to at least retest, at the minimum, the stock market I think is going to retest this bottom, right? So, if you guys are trying to figure out a good level to buy to start getting into the stock market, at a minimum, I would wait for it to start at least retesting 228, 248. What that means is that when the stock market goes down, it hits a bottom, it bounces off of it, it goes back to retest to get kind to say, okay, is this going to be the bottom and we're going to bounce off, or we're going to go continue to go down? At a minimum, I would start buying around here, or just delving, a couple thousand, maybe buy a share of stock, whatever your situation is, and then continue to go more. So that's my idea, guys. That's my direction. That's what I think is going on with the stock market right now. Again, I don't think there's ever really a bad time to buy stocks. I'm not a real big believer in timing the stocks, but even that in itself is relative. Meaning timing it as in what time frame, 6 months, a year, 2 years, so forth, right? The important thing to do when you're buying stocks or investing, I should say, if you haven't already started investing, is trying to make sure that you're getting them at discounts, right? You don't want to be buying stocks up here. You want to get them when they're falling, and you also don't want to put all your money in when the stock is falling just falling at a random level, because it can continue to fall more. So just make sure you stagger in. If you got your 401k, maybe put half in bonds right now so you have some cash for once things fall back over. If you're new to investing, maybe put a couple $100, buy a share of Apple. And then if you're like a millennial and you got a small 401k, or you want to start investing, maybe say, hey, what the hell? I'll buy a couple of shares of Apple, or a couple of thousand or 1,500, just to say I'm an owner. And then as things begin to hit these different levels, I'll start putting in, and then I'll wait for the cover and I'll get some profits. So that's my recommendation. Hopefully, I didn't ramble too much and I gave you guys some quality feedback and quality content. And let me know what you guys think. Obviously, I'm very open to the varying opinions. If you guys are like, nope, that's the bottom, and we're definitely gonna hit a few recovery and go to new highs, then absolutely, please leave your comments below. I'm definitely open to it, as long as they're all obviously respectful. We all have our beliefs, and we all want to do the same thing. We want to make money, right? And we all want to make money at the lowest point. So just keep that in mind when leaving your comments. And yeah, hit the like button, hit the subscribe button, hit the notification if you guys want to see additional videos. Other than that, thanks for tuning in, and check you later. Take care.